Okay, hello everyone. This is Russ Connie with Club Benchmarking. Happy New Year to everyone. I appreciate everybody joining us today. We've still got a number of folks coming in, but we're going to go ahead and start anyway. I appreciate everybody joining us today. This is about the 7th or 8th Fast Fact webinar session that we've done, and people seem to really like them. We do try to keep them down to about 30 or 40 minutes, and we're going to try to do that today. And I hope you find the information interesting. I think it was interesting putting it together. So, a little housekeeping. If you want to fire off questions, since we've got so many folks online today, I think we're going to use the chat box to do that. The best way to do that, you should, in the little GoToMeeting box down on the lower right, probably, you should have a place to enter in chat information. Towards the end, we have Terry Finan from our team on as well. We'll unmute her, and she'll go through and see what questions we might have. So we'll just get started off with that. I just want to take a second and confirm that what we're going to do today is talk about not necessarily all of them. We don't have time to go through all of them, but we're going to look at around 5 what we consider key performance indicators for clubs. And they're really 5 things that if you, as a GM, understood them, or as a controller understood them, or especially a board member, really understood where you were relative to those 5 indicators, it's going a long way to understanding the trajectory and kind of the current sustainability of the club. So we think, part of all this data gathering that we've done at Club Benchmarking over the last few years has been really valuable, because it's let us go through and data mine and really analyze and understand what are the things that seem to correlate to sustainability in club health. And those things, aren't really the same as the things, frankly, that clubs have been chasing as data points all along. So it's been pretty, we think, important for the industry to understand these. Just a little bit about, us again. Why do we do what we do? And it really, we really do believe that healthier clubs, more empowered managers, and more strategic boards come from elevating fact over opinion. That's really what we're all about. We've done a number of these other Fast Fact webinars, as I've mentioned. So we do always archive them, so you can go back and look at them later, or you can point to other folks in your staff or board members, point to them to get a little bit of a primer on a particular area. These are the areas that we've done webinars on so far, and if you go to this website, go to this web page on our site, you'll be able to have access to all those. It's real easy to do. So, today we have some relatively simple goals. Basically, we're going to look at some of these core key performance indicators for clubs that we talked about, or that we're going to talk about. I like to think about this stuff from the perspective of, there's a wide distribution in the country, in the club industry, around what really drives clubs, what's important. We all know the common theme of putting too much emphasis on food and beverage, financials. So I think about it. What if every GM, probably more importantly, what if every board member knew blank, and blank is some of the things we're going to fill in today. So if you had all those people who had a different level of understanding about the business model of a private club and what it means to be sustainable, you could literally change the industry overnight. We're not going to be able to change it overnight, but we chip away at it through activities such as this one. And so we'll look at these KPIs, and then we'll talk a little bit about why it's important to know where you are and why that particular KPI is important. I always do like to start off on some of these webinars with a little bit of framing information. We're just going to take a second here, because it's very interesting. The club industry is a $20 billion industry. It's a big industry, but it's also extremely fragmented. The largest player in the industry is about a $95 million club. So there's lots and lots of players. The median club is about a $6.5 million club. So it's unique as an industry in that most other $20 billion industries, you'd have 3 or 4 or 5 players that were maybe made up 50% of the industry, and then the rest would kind of segment down from there. But this is very fractured right from the start. If we just take CMAA as the baseline, there's about 3,000 clubs, and those clubs have about 33,000 board members governing those clubs, and they have about 3,000 GMs basically trying to guide those 33,000 board members. Very, very challenging, especially when you think that every year a third of those 33,000 people turn over, and every 3 years there's an entire new 33,000 people. And so when you think about it, what are the odds that any reasonable percentage of those people truly understands the private club industry. Now, they're members at clubs for sure, but do they understand the business model? And of course, the obvious answer is, well, they really don't, because they haven't had the background to. They understand their businesses or industries they've come from, but not necessarily the industry that they've now got a fiduciary governing responsibility for. So that's a big challenge, and that's why we think it's so critical for employing, facts over opinion in the club or in the boardroom. Just to not hit this too hard, but the reality of the world most clubs sit in is board members view, the club business is like my business. I own a restaurant. Why aren't our food costs at 19% or 20%? I have a warehousing business. Why aren't we watching our inventory? They try to impart their models on the club model, and it doesn't really work for the benefit of the club. So, I'm not going to go through all these, but I think you've all seen these kind of behaviors in the boardroom. I have no doubt there are board members on this call today, on the webinar today. I know there are CB subscribers, and I know there are CB non-subscribers. So we've got a wide variety of folks on here. But I think, a lot of these types of things or mentalities that exist inside the boardroom, people can really align with because they've lived through them. And if people really understood, if boards really understood what those key drivers are, they wouldn't say things like, well, not on my watch. We're not going to raise dues on my watch. Or, our club is different, so we can't look at, the models of the other parts of the industry. Those kind of things are hurtful to clubs, not helpful to clubs. So when we really get down to the meat of what we're going to look at today, what are the indicators we're going to look at? We're going to look at 5 core indicators. One of them is basically a gross margin-like indicator. We use the available cash model, but we're going to look at available cash as a percentage of operating revenue. Why are we looking at that? Because it reflects the liquidity of your revenue, and we'll talk about that more shortly. Basically the bottom line operational result of the club. We're going to use what we call a net available cash ratio, but it's essentially the result of operations of your club. The dues engine. Why are we talking about the dues engine? Because it is the cash driver of the club. Without a healthy dues engine, nothing else matters. Payroll ratio. Why are we going to look at that? Because it has such an extreme direct correlation to the operating results of the club. So as that ratio goes, so goes the operating results of the club. That's where we're looking at that. Finally, we're going to look at a capital generation ratio. Everything above that is basically operational perspective. We want to bring capital in. And why are we looking at that? Because frankly, if you're not on the right side of that, is your club what I'm calling a growing club versus a decaying club? Are you starved for capital, or do you have a healthy capital income and generation that lets you do things and renovate and keep the club looking healthy? We're not going to look at food and beverage today. We've certainly done that in the past, and there's a great food and beverage webinar that specifically focuses on and talks about how it's an amenity, not a profit center. But that's always a hot topic, so I wanted to explicitly say that we're not going to talk about food and beverage today. So let's get to the first KPI, the available cash ratio. Now, if folks have heard the term gross margin in other industries, it's kind of the gross margin of the club industry. And why is it important? Well, it's important because just like any business, in the club business, all revenue is not created equal. You've got $1 of dues revenue, and you've got $1 of food and beverage revenue. We know the $1 of dues revenue flows right to the bottom line, and there's 100% margin on that $1. The $1 of food and beverage revenue probably, if you're typical, costs you $1.05 or $1.10. So there's a negative margin on that. So this is about, you need to have the right mix of dues dollars, high margin dollars that contribute to the bottom line of the club versus dollars that really are just a supporting amenity and don't really help you fund anything else in the club. And so if we look at the industry runs at the median at about 60% available cash ratio, essentially gross margin. And it's a pretty tight curve. Half the industry runs between 55 and 65%. So that sort of tells you there's a pretty tight range of health relative to this ratio in the industry. Now, if we look at, we split this down the middle and we say, let's look at the clubs that fall on the left side of this curve and the clubs that fall on the right side of this curve. What we see is obviously 2 very different types of behavior. On the left side, 60% of these clubs are not supporting themselves operationally. They have a deficit. They're stealing from capital or from somewhere else to help patch operations. 6 out of 10 clubs. 40% of those clubs have a break-even or surplus generated. On the right side of the curve, if your margin is 60% or better, only 25% of those clubs have a deficit, and 75% of them have a break-even or surplus. So you clearly want to know where you sit on this curve, and if you're a CB member, I'm sure you've seen this chart before when you run your available cash report, you'll see where you sit. And it gets, do I have another chart here? It gets, yeah, let's do this. It gets even more extreme if you're sitting in this lower quadrant, this below 25%, in this 25th percentile. So if you're down here, you're probably at a 90% chance of having an operational deficit because you just don't have the horsepower, the liquidity behind your revenue. Likewise, if you're up here, you've got a 90% chance of having an operational surplus. Throughout these charts, I also throw in basically the top line numbers you're going to see deal with golf, clubs that have golf. And then if there are city yacht clubs, things like that, I also throw in the bottom here, if you don't have golf, you get to see where yours are. And you can see the ratios, the numbers are different. The median for city clubs or clubs without golf is 48%. That's the gross margin of those particular clubs. But very important to know where you are. And again, understanding that all revenue is not created equal is key, because if you're a club that's maybe struggling for cash and you've got a board or a direction that says, well, let's drive in more food and beverage revenue because that will give us more revenue. It's true it will give you more revenue, but it's not going to give you more operational cash. And so what that actually does is it actually drives your margin down because it brings in dollars, but no contribution from those dollars. So I hope that makes sense, and I hope it's intuitive and obvious as to why that's an important ratio. The next one is basically the what we call net available cash ratio. So it just looks at what's the operating bottom line of the club relative to the overall revenue of the club. And you have 3 opportunities. You can break even, you can have a deficit, or a surplus. Now, this is the break-even line in this industry, which is amazing because when you look at that, almost half the clubs in the industry still have an operational deficit. Their operational income is not supporting their operational expenses. So that's at about 40, so it's probably 40%. 40% have a deficit, and then about 60% have a break-even or surplus performance. And you can see the median is right around break-even, a 1% net available cash ratio. Again, knowing where you are in this curve, and more importantly maybe which way you're headed from last year to this year, because a lot of these things have trends. If you're heading up and to the right, that's a good thing. If you're heading down and to the left, that might be problematic. And we know that about 15% of the clubs in the industry are really in dire straits, and that's represented by this sharp decline over here. One of the key things to understand, especially if you're in this operational deficit range, the 40% of clubs, what I've written here is operational deficits lead to capital starvation. So if you're not supporting yourself operationally, generally the thing you go do is you tap into your capital, either your capital dues income or your initiation fee income, and you patch up that operations. So it is a slippery slope that goes from a poor or a deficit in operations leads to capital starvation. So critical to know where you are in this ratio and know which direction you're heading in this ratio. That's the second one we're going to look at. And by the way, golf versus non-golf, essentially the same. Median is at 1% for golf, 2% for city clubs. So it's very similar. It's very common. That's why we say that the club industry has such a common business model. And here's an example. This net performance of operations of clubs with or without golf are fundamentally identical. These numbers are basically the same. The third ratio we're going to look at is the dues ratio. And it's somewhat related to the first one we looked at, that available cash gross margin ratio, because dues is clearly the biggest contributor to the gross margin of your club. But this one wants to look, while that available cash ratio looks at all cash generation opportunities in the club, this one specifically looks at dues, and clearly dues is the most important thing from a revenue line that you can look at in the club. So it's really all about optimizing your dues engine. It is the cash driver. We're going to talk a little bit more about this than we do on some of the other ratios because it's important. But for the industry runs at 50% of a club's operating revenue comes from dues. And we can see it's pretty tight. The 25th percentile is at 45%, and the 75th percentile is folks that have 56% of their operating revenue coming from dues. So it's very critical to understand where you are. If you have a weak dues engine, it's very, very challenging to support yourself operationally. If we look at clubs that fall on this side of the curve, basically half the clubs here have an operational deficit, half the clubs have a break-even or surplus, and the median of these clubs is a break-even. On this side of the curve, only 30% of the clubs have an operational deficit, 70% of the clubs actually generate a surplus, and that median surplus is $132,000. And of course, it gets more extreme as you go to the edges, just like it did in the other charts. If you're in this lower quartile, 8 out of 10 clubs have an operational deficit. And this is something you're not going to be able to replace with other types of revenue. If you have a weak dues engine and a lack of dues revenue, you're not going to support that by having more banquets, driving in other things that maybe aren't a dollar-for-dollar contribution to the bottom line of the club. You really need to understand how strong is our dues engine, where are we on this curve, and are we moving up and to the right over time, or at least stabilizing, or are we moving down and to the left? Obviously, when things got bad and clubs started hemorrhaging members over the last 3-4 years, everybody's dues engine was getting weak. The challenge now is, have you come back out of it and strengthened up your dues engine, or is it still in a weak zone? And again, here are the components for non-golf clubs, and you can see their ratios are a little bit different. Still critically important, but they are a little bit different than golf clubs, and that's why it's important for folks to, say, use CB to filter themselves appropriately. So I hope that makes sense, but that's a critical ratio, understanding the strength of your dues engine relative to the size of your club. Just to talk a little bit more about this, we really do talk about it like a dues engine, and there's 2 cylinders in that engine. How many members do you have, and what's the dues that each member pays? And ultimately, that obviously puts out a dues revenue, but understanding what's the right optimization for our club is critical. We all know you can't, if you're losing members, you can't just hit your members that you have still for higher and higher and higher dues. That's eventually going to break down, and you're going to drive those members away. So you really need to understand, what does our dues engine need to look like, and how do we get there? I'm going to skip through this chart. And for folks that use CB, there's 2 charts in the available cash report. This one is your full member equivalents, and this chart is your annual dues that a full member pays. And so you want to understand, where am I relative to member count, and where am I relative to what a full member pays? Because it's the combination of those 2 things that really drive the power of your dues engine. There is a relationship that we've seen. It's very interesting as we've dug into this data. You can almost tell the value proposition of a club. Does the club have a visible, tangible value proposition based on those 2 metrics alone, or based on the dues engine? How many members? What does each member pay? For clubs, generally, I'm just going through this because I think it's good background information about the dues engine. For clubs that have a typical number of members for their size, and a typical dues charge for their size, and a break-even operating result, we usually say that's kind of a balanced club. It's got a good, solid value proposition, and everything is in balance. We also see clubs that have a higher than typical member count, a lower than typical dues per member, because they have so many members. They throw off an operating surplus, and we say that club has a very discernible, clear, and present value proposition. The opposite of that is a club that has an imbalance and is struggling with its value proposition. Too few members, they're really hitting the members hard, and they're not quite getting there, so they still throw off a deficit. The flip side of that type of club is very few members, higher than typical dues, but they throw off a surplus, and that quite often defines what your exclusive club. 200 members, they're each paying $18,000 a year, and the club is healthy, and it's an exclusive club. Just to reinforce, there's no substitute for dues revenue. We say you can't cook your way out of a weak dues engine. So I know I've hit this one particular metric hard, but it really, really is important to understand how much of a core driver it is and how there really is no substitute for dues revenue. Certainly things like guest screens fees, that has no cost. Those are good contributions, but things like food and beverage revenue is not going to drive your way out of a weak dues engine. We'll skip that for now, just for time's sake. The next indicator I want to get to is the payroll ratio. Why are we talking about this? Why do we consider this a core indicator? Because there's an extremely high correlation to the net operating result of your club. It is the biggest lever you have. It's more, in most cases, it's more than 50% of your expense goes towards labor, loaded labor. In fact, if we look at the numbers for the whole industry, at the median of the industry, clubs spend 55% of their operating revenue goes towards payroll. That's salary and wages and payroll taxes and benefits. And again, it's a pretty tight range. I mean, you've got about 9 percentage points, 8 percentage points that make up 50% of the industry. On the side with clubs with no golf, it's pretty much the same. You're a couple percentage points lower, but by and large, clubs without golf have the same labor ratios as the clubs that have golf, overall labor ratio. Obviously, once you get to the overall labor ratio, you can dig in and look and see, okay, what is it within food and beverage? What is it within G&A? And look in particular departments. But the most important thing is to understand where you are. It's very consistent. When we see clubs that are up in this upper quadrant, let's say greater than 59% of their revenue is going towards labor, it's almost impossible for those clubs to break even. Very, very, very difficult. So if you are up here, if you have a labor ratio which is up 60, 61, 62%, I can almost guarantee you're burning cash operationally. And it's very, all this is about cause and effect. It's just sort of simple math when you get into the numbers. It's not always easy to do, but if you move your labor ratio down, you're going to impact the bottom line operating result of the club. And we see it when we work with clubs, over a year or two, they shift their operating ratio down or payroll ratio down to what would be considered a more typical range. And of course, the net operating result comes up, and they've stopped burning cash operationally, and in fact, they've stopped stealing cash from capital income to use for operational patch up. On this side, 60% of the clubs have a deficit, 40% have a surplus. On this side, only 25% of the clubs have a deficit, 75% of the clubs have a surplus, and it's a pretty significant surplus. And as you get to the ends, it's even more extreme. Now, you have to wonder if you're down in this below 50, 45% labor ratio, are you supporting your club, your membership to a proper extent? The other clubs that we see down in this lower quadrant actually are the for-profit clubs. What's very typical on the for-profit side is everything else in their business model is exactly the same as the nonprofit. They just run with thinner labor. They shut down a little more often. Their hours aren't quite so wide in their restaurants and food and beverage operations. So they just run fundamentally with thinner labor, and basically the delta of that 6 or 7 or 8 points in the labor ratio is where their profit comes from. Everything else is basically exactly the same. The final ratio we're going to look at is what I call the capital generation ratio. It's a little different than just the capital income. And the reason we look at it is, and everybody knows when they walk through the front door of a club that is capital starved, you can tell when things are looking a little bit tired. Maybe the carpets are a little worn, the furniture's a little thinged up. You can get that sense when a club has been, frankly, starved for capital, and it's in that decaying part of the curve as opposed to the growing part of the curve, where they're talking about, we're building a new outdoor sitting area, new patios, new this, new that, or we're redoing some tees, whatever it might be. Those are different. There's different conversation inside the club, and there's also different, you can see it, you can sense it inside the club. So generally, you want to understand, does your capital generation meet your capital needs? And when I say capital generation, what we do is we take the net operating result of your club. So let's just say you had a deficit in operations. And then we take that deficit and we add to that your net initiation fees, any other capital income, investment or interest income, debt assessment income, and then we pull out your lease payments because we treat that as a capital flow. So basically we say net of operations, because if you had a deficit in operations, you generally stole from capital. That's why it's different than just looking at the capital income number. How much net of operations and net of capital income did the club generate and make available either for capital investment or debt reduction? Very, very important to know where you're on this curve. The median of the industry runs at 11%. Now, let me explain this ratio again. This says that the club generated, if a club's right at the median, a club generated 11%, it generated capital equivalent to 11% of its operating revenue. That money did not come from operating revenue, but we're just sizing your capital generation relative to the size of your club. Because if you're a bigger club, you had to generate more capital. If you're a smaller club, you needed to generate less capital. So we size your capital generation relative to the operating revenue of the club. And so if this were a $10 million operating revenue club and you were at the median, this club, net of operations, would have generated $1 million worth of capital that it could flow towards investment or debt reduction. Now, it's clear that in general, in fact, I would even argue that this, even at the median of the industry is somewhat capital starved. But clearly, if you're down in this lower quadrant range, you're certainly somewhat starved if you're only generating 5, 6, 7%. If you're in this 25th percentile, below the 25th percentile, we consider you very starved for capital. And in fact, we get back to that. We talked about those 15% of clubs that are really in trouble. We look at this 0% line, this break-even line. What we see is about 15% of clubs fall below this break-even line. Let me explain what that means. That means 15% of clubs, even after all their capital income, so after operations and all their capital income, they still were at a negative place, which means that even if they stole all their capital income for that year, they still could not patch up the deficit they had in operations. That's a very bad place to be, and it's really important to know, where you are on this curve. So, again, for CB users, go ahead and generate the available cash report and look to see where your blue dot is. If you're up in this range, you're probably okay, and if you're down in this range, you're probably in trouble, and you really want to understand that. And the reason I say probably is because understanding capital, there's really two sides to that equation. One is how much you generate, and the other is how much you need. So this gives us an understanding about how much we generate relative to what other clubs generate, which is not a bad place to start. But if you haven't really done a capital reserve study and you don't really know how much you need and when you need it, there's really no way to know how much is enough. So, I would certainly suggest start by understanding where you are on this curve, and in fact, are you in a good place and maybe moving up and to the right, or are you in an unhealthy place and even maybe moving down and to the left? And again, for CB users, you can look at see where you were in 2012, run the report, see where you were in 2013, and as you get your 14 data in, see where you are there. Really critical because, I really am a believer that capital-starved clubs, you're in some part of that spiral downward. Now, if you're deeply capital-starved and you've been deeply capital-starved for many years and you're down here, it's really, really challenging and, very hard it takes a lot of diligence, to understand it and to fix that. But if you're simply up here and you're moving down the curve a little bit, you really want to know that because you need to understand that and make some changes. By the way, the non-golf, almost exactly the same ratios. Virtually no different in clubs, capital generation, golf to non-golf clubs. Very quickly, why is this important? Well, we know that your sources of operating monies are different, your sources of capital monies are different, and you really don't want to go through a path of stealing from one to the other because it's not a, maybe you can get away with that for a year, but it's not a sustainable way to run your club. Obviously, those two things fund very different things. And, again, I'm going to talk for another minute about capital because I view it as being so critically important. You really need to train your membership that they don't stop funding capital when they join and just by paying an initiation fee. Just like dues has to pay for all the operational things they see and use every day in a club, they also have to continue as a member to continue to fund the capital inflow of the club. You can't just, pay for that once as an initiation fee and say, that's it. I've made my capital contribution to the club. Capital contribution to the club never goes away, and I'm going to skip through this for the sake of time. One of the ways we're very strong proponents of a capital dues. A lot of clubs use capital dues, but a lot of clubs don't use capital dues. And what a capital dues does is it puts a level of predictability into your capital income. If you're only using initiation fee for capital income, obviously, you're very very lumpy, and it's very much a roller coaster ride one year for the next as to how much you're going to take in. If you have a capital dues coming in from every member, which is now a predictable number, well, you've got a floor. You've got a baseline of capital is coming in every year. And then, of course, the initiation fee income, which is okay if it's lumpy, on top of that baseline is just a contribution to that. So any club that doesn't currently have a capital dues, unless you're in a mode where you've got a long waiting list and you've got a predictable turnover, therefore that capital income is predictable. If you're not in that scenario, we're big proponents of looking at a capital dues, number one, and number two, doing some study to understand what your needs are and when they are. And then, of course, primarily going back to this chart we just looked at, understanding where are you on this curve. This is the wisdom of the crowd stuff, right? Where are we on this curve, and help us understand our club. We're doing it through the lens of industry, from the data from industry, but ultimately we don't care about what other clubs have for capital. We only care what we have, and this helps us understand more about ourselves. Are we in a healthy place? Or are we in a place that probably has us somewhat capital starved? So that was our fifth and final ratio. I know I went through them awful quick, and frankly, I could spend 3 hours talking about all these. I'm happy to spend time talking to anybody about them. I want to just take a second and really talk about this in summary. And by the way, notice I have the same guy who I used up front about the don't be this guy is also, I think if you understand, it changes that guy, right? It can be this guy can have the answers or have the perspective that is healthy for the club, not unhealthy for the club. So, in summary, really know where you are using reliable standardized data. Using core ratios like this, it doesn't do all the work for you, but it clearly helps inform you to the underlying decisions and details that you need to make. It's really a stewardship of these 6 to 10, I only did 5, 6 to 10 core ratios that alert you when trouble's brewing. Or say that, what, everything is great. All ratios are right down the middle, or even a little bit better down the middle, and basically if we just keep managing the way we're managing, everything is great. It's amazing how many clubs actually are in good shape, but they don't know they're in good shape. So knowing you're in good shape can be as important as knowing if you're in trouble or not. But I really use that term stewardship seriously, because I do believe truly that if every club had a good understanding of where they sit with those 5 key ratios alone, they would have a different perspective of their club, and they would understand where should we put our effort and where do we not need to worry about putting our effort. Where should we leave it alone? Fundamentally, it's are you looking at the big stuff or are you looking at the little stuff? I say steer. It's a little tongue-in-cheek, but steer the ship. Don't swab the decks. If you're spending, an hour each meeting talking about the variance of cost of food or cost of beverage from the previous month, frankly, you're swabbing the decks. If you're talking about your dues engine, and are you at the optimum member count and the optimal dues amount, and is that engine putting out the amount you need? That's steering the ship, not swabbing the decks. And so that's why I think it's a reasonable analogy, because we all understand exactly what I'm talking about when it comes to clubs. So what I want to do now is jump to the Q&A section. I'm actually going to unmute Terry Finan, because I think she's been keeping an eye on the questions coming in. It looks like there was probably quite a few. Terry, you there?
I am here.
Great.
Okay, so the first question is, are the formulas for all of these ratios discussed available somewhere?
They all, they're not on an it's a good idea. They're not on a separate piece of paper. They're certainly all automated inside of club benchmarking, so when your data goes in, it automatically generates. We can probably write that up and do that as a little bit of a white paper. Is what is the math behind all these? Now I kind of know what happens as clubs go and they say, well, let's build our own spreadsheet and see where we are. Usually what happens is the math becomes cumbersome and they just say, well, I'll just join and do it that way. But yeah, the math isn't hard. So the only one that's a little tricky is the available cash equation. And then a lot of them flow off of that. But we'll see if we can put together a little bit of a math sheet, and we'll post it on the same page as these webinars, as a little extra link next to it maybe, so that you can go to that. That's a good idea.
Okay, someone asked for Jim Boyle's contact information. I just put up an email address for Jim. To be clear, the presenter today is Russ Condi, our COO. And I entered his email address as well. So the next question is it possible to get or make copies of these slides? I'm not familiar with GoToMeeting. And certainly an email will go to everyone who registered, whether or not you were able to get onto the session, and it'll be a link to the video so you can actually play the whole webinar back. I think we can probably include the slide deck as well. Bruce asks, payroll chart, did I not fully understand your explanation? For clubs below the median payroll cost, my notes say that you quoted 60% showing deficit, whereas clubs above the median, higher payroll costs, I put a note that only 25% operate as a deficit. Is that correct? Seems to me would be the opposite.
Oh, you know what? I did do that backwards. You're exactly right. These should be flipped. Thank you. That's very good. That would be one heck of a trick. Yeah, these two are flipped back and forth. That's my fault. So yeah, you got it exactly. Obviously, intuition takes over there. So thank you for that.
Yes. Next question: what is the definition of available cash?
Available cash. There's a white paper on our homepage which you can download, which is probably the easiest way to get a deep understanding of it. Basically, it is the it's the view of where does our cash come from to run this club, and where does it go. So there is a formula for available cash. It's in that white paper. Go download it. It's very specific. We basically net out your revenue producing departments. We take in your membership dues revenue. We do some other math to it, and it generates the pile of cash that you have to pay for your course and G&A and other things. So the easiest, rather than do it all here, the easiest thing is just go to that home page at the bottom, download that white paper, and that should help you out. And obviously, we're happy to answer any of the questions you have.
I'll also include a link to the available cash white paper in the follow-up email.
Oh, great.
Bruce says he's glad to know that you're human.
Yeah, it happens. It happens.
Okay, I don't see any further questions. Oh, yes. Okay. Where can we find info on your other core ratios, and what about ratios for operational or contingency reserves?
Yeah, there's certainly, we do have all that data. It's inside club benchmarking, so I don't know who asked it, but if you're a subscriber, you can go inside and run the balance sheet and capital report, or go in and look at the all kinds of different ratios. There's others. I mean, what we'll probably do is do another webinar series that maybe do the next 5, and we'll pick another set of them. Mm-hmm. I think keep an eye on our other webinars. Watch some of the other webinars. They all have ratios that are relative to their topics, course maintenance or food and beverage, etc. Mm-hmm. So we'll just keep talking about them and keep putting them out there.
If you go to clubbenchmarking.com and click on the link to the resources page, you'll find a lot of the white papers and the videos. And John asks, how many clubs make up this survey?
Oh, well, this is the whole database. So, we're talking data from more than 1,000 clubs that are in this. So, very, very diverse set of clubs. The definition of the wisdom of the crowd is a diverse set of information, and this is a diverse set. What's interesting is when we slice the set, though, and we go from, the whole database down to subsets of all kinds, different size, location, everything, these core ratios don't change by size of club, by location of club, in some cases even whether they're a golf club or not, as you saw. So that's key to understand, is these ratios are ubiquitous, and the value of these ratios are ubiquitous across the industry. We've really broken, we've shown that the myth of, every club is different, unique, and special isn't true. There's a common business model, and that common business model, is defined by some of these common ratios that we're looking at.
To be clear, we do the data gathering and analysis for the Club Managers Association of America for the CMAA annual surveys. So we have all that data, and we also have more than 500 clubs actually subscribing to the platform and using it. So we have that combination. There's overlap in some of that.
Okay, is that it?
Just another request to do more webinars on other key ratios, and I think that's
we
it.
can do that. All right. Well, what we'll do is certainly if anyone comes up with any questions after the fact, you can certainly get them to me or get them to Terry. And I appreciate it. We will be doing another Fast Facts webinar down the road shortly, and you'll all get informed of that. I appreciate everybody joining, and I hope this was valuable for everyone. I enjoyed doing it, and thanks, and we talk to you soon. Bye-bye.